So greetings, everyone, and welcome to our webinar about charter schools and tax-exempt bond financing. Tax-exempt bond financing is probably the primary form of financing used by charter schools to acquire and renovate their facilities. We're here today to discuss the basics. What decisions do charter schools need to make before they can begin the financing process? What can they expect as they proceed with financing? What steps will they need to take to properly account for the financing? And what do they need to know about maintaining the tax-exempt status of their bonds? Before we get started with the substance of our program, we'd like to share our background and review the logistics of a Zoom webinar. My name is Elka Sachs. I'm a partner here at Krokidas and Bluestein and share our education and nonprofit practices. I've been working with charter schools here at Krokidas and Bluestein since the first charter schools formed in Massachusetts in 1995. We have a full-service charter school practice, including governance, state ethics, contracting, public procurement, real estate acquisition and development, finance, employment and labor law, special education, and student discipline. And we're honored to have represented the Massachusetts Charter Public School Association, today's host. Sheryl, would you like to introduce yourself?
Certainly. I'm Sheryl Howard. I'm also a partner at Krokidas and Bluestein. I'm in the transactional group where I assist our charter school clients with real estate, leasing, and finance.
And John.
Good afternoon, everybody. I'm John Buckley. I'm a partner with AAFCPAs. I lead our education practice, and along with Elka, I think we've been working with the charter industry since about 1995 as well, and currently work with a lot of Massachusetts schools as well as schools in Rhode Island and New Jersey.
And Eric.
Good afternoon. I'm Eric Russell. I'm an associate at Krokidas and Bluestein. I work in the nonprofit organizations practice, and I do a variety of tax and corporate work for a variety of nonprofit organizations.
All right. So regarding the logistics, we're going to be taking questions from the Q&A function. The Q&A is at the bottom of your screen. The webinar will be recorded and distributed after this session, but the Q&A function will allow you to remain anonymous while you ask your questions. Please remember, as you ask questions, that although Sheryl, Eric, and I are attorneys, attorney-client privilege does not attach to our discussions because these are not one-on-one discussions between an attorney and client without any third parties present. Thank you again for being here. And now to begin. And we're going to start off with a poll question. Okay, so first question, has your school acquired or renovated your school facility? So 77%, a little over 3/4 of you said yes, but almost a quarter haven't yet. And if yes, did your school use tax-exempt bond financing? And here 77% said yes, and 23% said no. So about 3/4 of those who have acquired it or renovated their school facility use tax-exempt bond financing. There are some other options out there. New market tax credits is one, and that can be used with or without tax-exempt bond financing. And sometimes we've worked with clients who use conventional loan financing. All right, so on to the substance. I'm going to lead off with a brief discussion of charter school financing structure and some of the legal and financial implications of that structure. Almost all charter schools have an affiliated entity which engages in fundraising for the charter school. Some of these are called friends organizations or foundations, but some aren't. Some have a close corporate relationship to the charter school and might even be considered governmental organizations, but some don't. Many don't. Most are tax exempt, although occasionally some are not. I'm going to refer to all of these affiliated organizations as mission affiliates because all of these organizations are affiliated with the charter school through their mission. When a charter school with a mission affiliate seeks to acquire real estate or renovate a building, 3 interrelated decisions must be made. The first decision is whether the charter school or mission affiliate will own the real estate. It's going to be one or the other. In a few minutes, we'll talk about some of the reasons why a charter school might prefer to have its mission affiliate own the real estate. The second decision is which entity will serve as borrower and which entity will serve as guarantor in the financing. Typically, the lender will want to ensure that both the charter school and its mission affiliate participate in the financing because each has a source of revenue that will permit repayment of the financing. The charter school receives per pupil payments, and the mission affiliate receives and holds fundraising. Often the lender is comfortable with allowing this decision to be made by the charter school, but not always. Sometimes the lender will dictate the decision. If the charter school is the borrower, the bonds will be governmental bonds because the charter school is a governmental entity. If the mission affiliate is the borrower, and assuming the mission affiliate is a nonprofit, the bonds will be 501c3 bonds. There are some slight differences between the 2 types of bonds, which we will discuss in the course of the presentation. Whichever entity owns the real estate will secure its obligations with a mortgage. In other words, if the borrower owns the real estate, whether it's the charter school or the mission affiliate, the borrower will grant a mortgage to secure the loan. If the guarantor owns the real estate, and again, whether the charter school is the guarantor or the mission affiliate is the guarantor will grant a mortgage to secure the guarantee of the loan. That way, the lender ends up with a mortgage, regardless of how the financing is structured. The third decision results from the first regarding ownership of the real estate. If the mission affiliate owns the real estate, it will lease the real estate to the charter school, which then might license some space back to the mission affiliate to use to hold its files, maybe some office space. If the charter school owns the real estate, it might also grant a license to the mission affiliate to use some space for record keeping and some office space. On the subject of mission affiliates, there are a number of reasons why these are formed, some of which tie directly to the charter school construction and renovation. First and foremost, mission affiliates are used to assist with fundraising. For several reasons, some donors prefer to make grants to mission affiliates. Some donors are more comfortable with the deductibility of donations to a 501c3 than deductibility of donations to a governmental entity. And some private foundations are required to make grants to 501c3s and cannot make grants to governmental entities. Some donors are also concerned about the risk of reversion of their gifts to the state in the event that the school loses its charter. For all of these reasons, the mission affiliate's fundraising can help play a role in the acquisition of real estate and in school construction and renovations by facilitating a capital campaign project. For charter schools with multiple buildings, use of a mission affiliate to fundraise and to own a facility might more readily permit segregation of the different financing and fundraising by facility and eliminate the need for an intercreditor agreement among different lenders to different building projects. Sometimes a special purpose entity is required to engage in a financing transaction. That's true, for instance, when new market tax credits or historic tax credits are used. And yet another reason to have a mission affiliate is that it may be a private entity that is not subject to all government entity requirements, but this depends on how the entity is structured. Some governmental entity requirements are operational, like open meeting and public record laws, but some are very specifically construction related. Construction-related government entity requirements include the obligation to comply with public procurement requirements when engaging in construction-related activities. A second is the obligation to pay prevailing wages when engaging in construction-related activities. And the third is the obligation to utilize a state designer selection process when engaging an architect or similar design professional. So I want to be clear that the mere use of a private mission affiliate for construction purposes without more does not entitle the private mission affiliate to proceed with construction without complying with the public procurement, prevailing wage, and designer selection statutes. If the mission affiliate is an alter ego of the charter school, government entity requirements are going to apply. A mission affiliate is going to be considered an alter ego if the charter school controls the entity, such as when the charter school appoints a majority of the mission affiliate's board, or because a majority of the mission affiliate board is comprised of charter school trustees or employees. Similarly, if the funds for construction or retaining the architect are sourced from the charter school, or the charter school controls the process, or the purpose and function of the construction or renovation is very school specific, for instance, kindergarten bathrooms are school specific, a roof is not. Then the public procurement and prevailing wage statutes are going to apply. And that's even if the mission affiliate is completely private. And similarly, the designer selection statute may well apply. However, in many cases, the private mission affiliate might choose to make ordinary course repairs or even fund general capital improvement projects such as a new HVAC system using private donations under the oversight of the mission affiliate if the mission affiliate owns the building. In those cases, an argument likely exists that the public procurement, prevailing wage, and designer selection requirements do not apply. A good rule of thumb is that a main project, a primary project, will be subject to designer selection, public procurement, and prevailing wage, while subsequent projects might not be. So having given some introductory material, I'm going to turn the presentation over to my transactional partner, Sheryl Howard, who will begin by explaining what is tax-exempt bond financing.
Thank you, Elka. So what is tax-exempt bond financing? Generally, these are bonds that are issued by a state or local government issuer, and the bond proceeds are then loaned to finance a project that benefits the community. So, you could have taxable or tax-exempt bonds. Tax-exempt means the interest is exempt from federal and sometimes state and local taxes. And as a result, tax-exempt bonds are usually at a lower interest rate. You might have a project that includes both, in particular, because you can't refinance conventional financing with tax-exempt bond financing. If you have a project where you're refinancing some debt that was conventional financing, you're likely to have a piece that's taxable and then a piece that's tax-exempt. Two other categories that Elka alluded to in her presentation are kind of government versus private activity or 501c3 bonds. As the name indicates, a government bond is intended for a government project, and a private activity bond is for a project that primarily benefits a private tax-exempt entity. You could see a charter school structured, having their financing structured either way. If where the charter school itself is the owner and the borrower, that could potentially be a government bond, whereas if the mission affiliate is the borrower, that would be structured as a private activity bond. I was going to hand it over to Eric briefly to give you just a little bit of background about one of the key differences between government versus private activity bonds, and that relates to private business use.
Yeah, so I will talk later in the program about private business use, what it is and what the restrictions are relating to it. But this is one of the key differences between government and private activity bonds. Private business use is defined slightly different differently for each of those types of organizations. And there's a threshold of allowable private business use that you can't go over for the bonds to continue to qualify as either governmental or 501c3 bonds. And those thresholds are slightly different.
Thank you, Eric. So what are the benefits of tax-exempt bond financing? The key benefit is that typically these are at lower interest rates than conventional financing. Obviously, in this environment, that's incredibly appealing and may allow you to build the project you want to build. The drawbacks, it is a more complicated structure. As a result, there may be slightly higher closing cost. It may require additional staff time, both for the closing and kind of after closing some of the reporting requirements. Another consideration is that if you are expecting to need to transfer property that has been financed using tax-exempt bond financing, you'll want to take that into consideration because it can be more difficult to transfer property that's been acquired or improved using tax-exempt bond financing. So parties to a tax-exempt bond financing. And I'm actually going to kind of hit the bottom of the slide first. So tax-exempt bond financing can either sell the bonds in the capital market, or they can sell them directly to your lender or to a single financial institution. For purposes of this presentation, we're going to talk about the latter, where the bonds are owned by a single financial institution, only because that's more common in our experience. For that, the parties to the tax-exempt bond financing would be the lender or the bond purchaser, the issuer, which is a public entity, typically we see Mass Development, and then the borrower and guarantor, that would be the school and the mission affiliate, depending on how you've structured it. We do recommend strongly that you obtain separate counsel for all of these parties, even though it does lead to slightly higher closing costs. The benefit of having separate counsel for these parties we've seen that again and again. You just end up with better documents at the end of the day if you have your own counsel. So when you're looking for a tax-exempt bond financing, you're essentially looking for a loan. So the things that you would consider when comparing term sheets are largely going to be similar to any conventional financing term sheet that you've seen. One item that I want to mention up front is that there's a strong benefit to shopping the deal. Banks underwrite these deals in different ways. And just anecdotally, we recently had a client that went to their long-term lender for a tax-exempt bond financing. For other reasons, decided they wanted to solicit additional offers and found out through that process that their long-term lender, who they generally had a good relationship with, had actually not given them the best deal. So in their case, they used the other offers to leverage some beneficial changes with their existing lender. So there was a real tangible benefit to shopping the deal and seeing what you can obtain. In terms of the term sheet considerations, eligibility, you need to be eligible for tax-exempt bond financing. You'd want to pay close attention to the interest rate and any rights to adjust that interest rate. The term tax-exempt bond financing is typically long-term, so that's often a benefit for borrowers. The collateral, this is going to be a really key consideration. Clearly the real estate is likely to be mortgaged and be part of the collateral, but the lender may ask for additional collateral. So are there any restricted assets, assets that you're not allowed to pledge? Do you have investment accounts? We've seen some investment houses that won't agree to sign a control agreement, which can make it harder to pledge that asset. Do you need the flexibility to transfer assets? If you have investment accounts or an endowment that you draw from and need that ability, you need to take that into account. And last, per pupil payments, those cannot be pledged in Massachusetts. So just keep that in mind when you're reviewing the term sheet. The guarantor, as we mentioned, the guarantor might be the mission affiliate, or it might be the charter school itself. You could be structured either way. And then the financial covenants and financial reporting. These could apply to the charter school, the mission affiliate. They could apply both. They could apply jointly or separately. So you want to be careful when reviewing those, which entity they apply to and how that's going to be calculated. The covenants need to be achievable. So you want to think about whether there was anything particular to this year that made it different from other years. Make sure you have a little bit of a margin to achieve those covenants. And then the financial reporting should sync with your existing processes. So you don't want to have to change what you're doing in terms of financial reporting to meet the bank's requirements. So certain operational covenants, consent or approval rights over changes. This could be changes in management, changes to the board. For nonprofits, I often push back on changes to the board, in particular because you have a volunteer board and there may be changes that you don't anticipate over time. Prohibitions on additional indebtedness. You need to think about when do you need to take on additional indebtedness, and make sure those are carved out. And then, operating accounts, keeping, they may limit where those can be and how they are managed. The structure of debt and repayment. So you'll want to, especially if you are using a tax-exempt bond financing to do construction, you'll want to understand the timing of the release of funds to make sure that's going to be functional. Letters of credit or credit enhancements may be part of the transactions, and interest rate swaps. We're increasingly seeing these as part of the financing package. They're a useful tool for hedging against variable interest rate risk, but they can be complicated and there can be costs associated with breaking the swap, for example. Typically, you would have a swap advisor to help you walk you through that, but be aware that that might be part of the term sheet. So a subordinate debt. Again, you cannot refinance conventional financing with tax-exempt bond financing. So if refinance of some sub-debt is part of the package, it may come in as taxable bond financing, or you could have subordinated financing. In that case, you would want to think about intercreditor issues and make sure the timing of approvals and disbursements are connected so that you don't have a subordinate lender kind of tying up the process because their ability to provide a consent in a timely way is limited. Last, it bears repeating. We strongly recommend that you shop the deal to make sure you're getting the best deal that you can. So in gearing up for a tax-exempt bond financing, there's a lot of initial due diligence that you can do. So for instance, if you already own the land, did you get a title policy? Was there a title rundown? Pulling together your title documents. You may even want to have title updated to see if anything has been filed. Sometimes you'll see an old discharge has not been recorded. You might find a notice of contract if you've done other construction that's been recorded. So it's helpful to understand the state of your title and perhaps do some cleanup in advance because some of those items can be lead time items. Survey, similarly, if you already have the land, pull your prior survey. You may need to do an updated survey. If you're acquiring the land, certainly you'll be doing title and survey as part of your standard buyer's due diligence. Environmental, pull any prior phase one that you've done. A new phase one is going to be required or very likely to be required by your lender. And basically you'll need your LSP to provide a reliance letter to your lender. So you can anticipate that if you're having a phase one done. Corporate housekeeping. This is a big category. So for the mission affiliate, have you filed all the annual reports that you need to file with the Secretary of the Commonwealth? Bylaw review. Are your bylaws sufficiently clear that an attorney reviewing them could issue the opinions they'll need to issue to the lender in connection with the financing? For the school, pull your charter. You can request charter documents from DESE. And then for both entities, you're going to need a number of board votes. First, has your board been told about this potential financing? Are they supportive? You'll want to look at your meeting schedule, particularly for the charter school, because of the open meeting law requirements, and see if the timing is going to work or whether you're going to need to schedule additional meetings. One vote that needs to happen early on in the process is the intent resolution. This is it's basically an expression of the organization's intent to engage in tax-exempt bond financing. The reason that we recommend taking this vote sooner rather than later is that it allows you to be reimbursed for some expenditures incurred up to 60 days prior to taking that vote. So the vote basically starts the clock on expenses that you may be incurring prior to the transaction. So you want to take that vote early in the process, and your counsel or the issuer's counsel can provide the text of that vote. And last, you'll need to approve the financing. This vote will be scrutinized in connection with your attorney issuing their opinion. The best practice is to have your attorney draft those votes and then circulate the drafts in advance to the issuer's counsel and the bank's counsel, so that you include all the changes that they want to see, and so that your attorney is comfortable issuing the authority opinion. The schools will need to authorize, for the schools, there's going to be additional votes. You're going to need to authorize the submission of a request to DESE for debt that extends beyond the term of the charter. That's going to apply whether the school is the guarantor or whether the school is the lead borrower. You may need to take additional votes around procurement, construction management at risk. So it's worth thinking about what votes need to happen in advance. And then existing financing and approvals. If there is existing financing on the property, you'll want to dust off some of those loan documents, find out if there's any prepayment penalties. If the debt is going to remain in place, you want to understand what types of consents you're going to need. Appraisal, I think that's obvious, but it can be a lead time item these days. Insurance, you want to review your existing coverage. And also understand the lender's requirements around insurance. Find out how they want to be listed on the insurance certificate and get that in the works sooner rather than later. My experience is that you usually don't get the insurance certificate in correct form right out of the gate. Usually there's some back and forth. So it's worth putting that on your broker or your risk manager's radar so that that can be in the works. UCC and litigation searches. So your lender will certainly require these. You may want to consider doing them in advance. One of the advantages is that, in theory, you should know what litigation is out there. You may want to talk to your lender about any litigation to make sure it's not going to pose a problem. For the UCC searches, we often find that when we run a UCC search, that there are UCCs that have been filed against a client that often state the collateral too broadly. For instance, an equipment lease UCC that lists where the collateral is not listed just to the equipment leased. So it's helpful to understand what is out there and then do some cleanup if it's needed. The TEFRA notice, this is a notice that the issuer will provide. I'm mentioning it here only because it's a lead time item, that's something that your issuer is going to need to do. And then DESE approval for debt that extends beyond the term of the charter. Again, this is going to apply whether you've structured the deal with the school as the guarantor or as the lead borrower. That is a lead time item, so you'll want your school to authorize that request. And there's some specific language that needs to either be in your term sheet or in a side letter from your lender in order to obtain DESE's approval. So it's worth keeping that on your radar, making sure the right language is in the term sheet, getting authorization, and then getting that submission into DESE as soon as you can. And I'm going to now hand it over to Eric, who's going to discuss some of the 501c3 due diligence you need to do.
All right, so as Sheryl mentioned earlier, there are some opinions that have to be issued in connection with tax-exempt bond financing. One of those is a 501c3 opinion. Borrower's counsel will be asked to provide this opinion, and it states that the borrower qualifies as an exempt organization under Section 501c3 of the Internal Revenue Code. So in order to provide that opinion, we have to review certain documents to understand the basis on which the organization obtained exemption and its current activities. We also frequently have a fair amount of discussion with clients so that we fully understand what their current activities and operations are. So one of the first documents we look for is the borrower's determination letter. When an organization obtains 501c3 status, the IRS issues this letter known as a determination letter, and that should reflect the borrower's name, EIN, and support status, whether it's a private foundation, supporting organization, or publicly supported organization. we need to start looking for that early on in the process, because if the borrower has lost its determination letter, or if any of that information is incorrect, we have to go to the IRS and request an affirmation letter. Processing times at the IRS can take quite a long time, so we need to figure out very early on whether we need to go to the IRS and ask for that letter. Some organizations may not have a determination letter at all. In the case of group exemptions, for example, the central organization obtains tax exempt status and its affiliates will be considered exempt due to the relationship with the central organization if certain requirements are met. If the borrower is a type of organization that doesn't have a determination letter, or if a determination letter can't be located by either the client or the IRS, there are other documents that we can rely on to determine if the IRS has granted exempt status or if the organization has exempt status for some other reason. Bond counsel used to accept an opinion regarding 501c3 status that relied solely on the organization's determination letter. In our experience, however, that's no longer the case. That means the determination letter is an important part of our review, but we can't rely solely on that when providing the Section 501c3 opinion. The next document we look for is the borrower's application for tax exemption, known as the Form 1023. It's not unusual for organizations to lose this document, and just like with the determination letter, getting a backup copy from the IRS can take a long time. So as with the determination letter, it's important to figure out early on whether you have a copy of the application for tax exemption, or if we need to request this from the IRS. The 1023 contains a lot of information about the organization and the exempt activities that it expected to engage in at the time that it filed its application. The C3 opinion can be really easy for us to provide if the borrower fully described its activities in the Form 1023, those activities haven't changed, and the standards applied by the IRS have remained the same. In those circumstances, the determination letter and the Form 1023 together provide strong evidence that the borrower continues to qualify as tax exempt because the IRS made its determination on the basis of facts that remain substantially true. For organizations that have been in existence for a long period of time, however, it's not unusual for the organization's activities to have changed or expanded. It's also possible that relevant IRS standards have changed as well. One borrower that I recently worked with started out many years ago coordinating volunteer services, and now it's a direct provider of a wide range of health and human services. So its current activities exceed anything it contemplated when it filed its Form 1023. And even if it had anticipated these services when it applied for exemption, the test that the IRS now applies has been modified since it was first formed. So this type of expansion might be less common with C3 affiliates of charter schools, but we do see some with, that grow and change over time. So it can happen with them as well. Where an organization's activities have changed from when it filed its Form 1023, we've got to go further than just reviewing the determination letter and looking at the current activities. We need to review the current activities against current IRS standards that would apply if the organization was applying for tax exempt status again today. That requires review of the manner in which activities are conducted and frequently requires review of revenue sources as well. Sometimes we end up recommending that a borrower take certain steps to strengthen the position that it continues to qualify for tax exemption or to satisfy newer standards. That can happen because revenue sources have changed, an alternative basis for exemption is now stronger, or because the IRS standards have changed. It's important for us to begin this process, the diligence process, really early in case any steps need to be taken, like adoption of a policy that might require board action. So as part of this process, we also review the annual returns that are filed with the IRS, known as the Forms 990. These are publicly available documents, and they'll usually be available online for some years. We'll usually have to request the most recent 1 or 2 years from the client because those won't be available online yet. We frequently look at maybe the most recent 5 years. And we review those to confirm that activities and operations are accurately reported to the IRS, to see if there are any other factors that could be a problem, such as private benefit issues, how conflicts of interest are handled, how executive compensation is set, and whether the organization engages any other activities that need to be evaluated further, like joint ventures with for-profit entities or activities that give rise to unrelated business taxable income. Once our review of all those documents is complete and we're satisfied we can give an opinion, we prepare a document known as the opinion certificate to be signed by an officer or other person authorized by the organization. This certificate sets forth essential facts about the organization that are relevant to its tax-exempt status, and then we rely on those representations in providing the 501c3 opinion. And now we're going to turn it back over to Sheryl to discuss public procurement.
So to kick us off, I have another poll question for you. Do you expect to build or renovate a new facility in the next year? So 33% of you said yes, so that's a pretty good chunk, and 67% said no. So the rest of my presentation is going to be focused on some of the aspects of building or renovating a new facility. So many of you are already very familiar with public procurement. For a construction project of this scale, you're very likely to need to procure an owner's project manager if the construction's over 1.5 million. You will need to go through the designer selection board or the DSB to procure your architect. And you will need to pay prevailing wage and go through a public procurement process. Early on, it's helpful to decide whether you want to go through standard procurement or general procurement, or whether you want to use construction management at risk, or CM at risk. CM at risk was designed, there was a great deal of interest in the private sector around design build, which basically where you retain a single group to design and build your facility. So you don't have a separate architect and general contractor. They're all part of the same team, and they're kind of working together to get the building that you want built on budget. In the private sector, that was very popular. CM at risk was adopted in reaction to that, although there are some key differences between CM at risk and design build. So it's worth understanding those and understanding how that impacts your timeframes and cost early on in the process. And just as a side note, if your lives weren't complicated enough already, it's possible that federal procurement might apply. For example, the charter school program grants or CSP grants, those are federal funds and they are subject to federal procurement rules, which are different from the Massachusetts rules. So if you have federal grants, be aware that you might also need to comply with federal procurement rules. Construction financing due diligence. So your lender is going to have a number of requirements for insurance, for release of construction proceeds. So it's worth understanding what some of those are before you sign contracts with your general contractor. For your architect, you'll want to think through and make sure there's provisions that allow you to assign that contract to your lender. It's very likely that your lender is going to require an assignment of certain key project documents, including the contract with your architect and with your general contractor. So assignability is important. You may need to understand what your lender wants in terms of requisition forms and make sure your architect is willing to use those forms. You'll want to understand what your architect's professional liability insurance limits are. Some lenders have requirements in that arena. And then you'll want to understand what your rights are with respect to the plans that are prepared by the architect. So you want to make sure you have rights to those plans going forward. For your general contractor, I think ideally, the general contractor's agreement would be negotiated but not fully signed at the time that you are signing the term sheet or commitment letter, only because the lender may want to be involved in that process. Obviously, pricing and budget are key. They're key for your lender and they're going to be key for you. You want to understand if you have kind of a guaranteed price. You want to understand what are the circumstances under which that price could increase. I've seen, especially recently, more GC contracts that include rights to increase the cost if building materials or labor costs exceed a certain threshold. I think it was the GC's effort to hedge against some of the risks in this current environment, but you want to pay very close attention to those because those have a real risk of kind of blowing your budget. Similarly, the contract with the GC will need to be assigned to your lender. So you want to make sure you preserve that right. And you'll want to understand your lender's bonding and insurance requirements. Permitting and zoning, obviously, if this is a new project, you'll want to make sure that you have all permits or zoning relief required. Because this is an educational use, it's likely protected by the Dover Amendment. So you're unlikely to need zoning relief in connection with your use, but there could be other zoning requirements that where you might need some relief. So it's worth kind of making sure you're in good shape with respect to your permitting and zoning. And then regulatory permits. This comes up primarily in connection with if you have an on-site daycare. And whether that's operated by the school or by a private third party, you'll want to make sure that you have the permits in place. Next slide. MHC. So if you are obtaining tax exempt financing, you'll need to file a project notification form with MHC, even if your project has no historical interest or value at all. That application is triggered by virtue of the funds that you're receiving. You're receiving you're receiving public funds. And so that triggers the need to file with MHC. If your property does have historic interest or you're in a historic district, you need to budget additional time for that. Otherwise, if the project if the existing space has no historic value, then typically you file your form, and then very close to 30 days, you get a copy of your application stamped by MHC, basically saying that there's no historic value. MIPA, you'll want to work closely with your engineers to see if any of the MIPA thresholds are triggered. Those are relatively technical, so it's you work hand in hand with an expert in that area, and then you may need other approvals from DEP or your local conservation commission. If there are wetlands on the site, I recently had a site where it had its own wastewater treatment plant. And so that had a DEP permit that had to be transferred. So you want to understand what additional permits or approvals are going to be required. And I'm going to hand it over to John to give you some information about post-closing accounting considerations.
There we go. Thank you, Sheryl. So if you've made it through all of that and you went ahead and you applied for, went for a bond and you got the bond, congratulations, you have it now. And what we thought we really want to talk a little bit about is some of the pitfalls I've seen, kind of after you've closed on a bond, you've got a bond. What do you need to do to make sure you stay in compliance with the bond? You make your kind of the whole transaction go smoothly. You've recorded things from an accounting side, so that when you come in to do your annual audit, that audit goes smooth and you don't end up with any large adjustments that could potentially have findings, which I know a lot of lenders don't like findings, and the state obviously doesn't like findings. So we've put together a few items here to kind of keep in mind. So from the debt perspective, once you close, it's, as we saw, it's hard getting the bond. It's also some work to maintain the bond and keep the bond and make sure you're in compliance with that. But I think it's important to, kind of receive the complete transcript, read the transcript, read all of the documents, make sure that you have all of the signed documents, because those documents that you receive during some of the initial stages that aren't signed aren't going to do you much good later on. So make sure you receive that signed legal document and read it all, because within there's a lot of things that you're going to want to understand. You're going to want to understand the transactions. You're going to want to understand what you need to do to kind of maintain that bond. So I always recommend kind of taking some time and reading that. And it's always good reading at night, may help put you to sleep. But there's a lot there. So make sure you kind of read that. Included in that transcript, there's typically a summary of closing transactions with a cash summary in there. And that, from an accounting standpoint, is a great document because it shows you all of the transfers of cash, what's happening, it's a very, in my mind, it's a good kind of accountant summary of the deal and how to record that transaction. We've seen cases where you may close and another account may be funded. And if you're just kind of looking at what goes through your bank account, you may miss a piece of it. So, it's always a good idea to kind of look at that summary of cash transactions to make sure that you have kind of the complete deal recorded on your financial statements. As you get into, starting to pay the bill, right? Because, you got this debt. Now at some point you got to stop paying because the banks like to get their money back. You want to make sure that you have that amortization schedule. So either it's, a lot of times it's included in the closing. If not, you need to work with the bank to get that so you understand the proper allocation between your principal and interest, during the course of the year. So that's an important piece to get. A calendar of due dates. As Sheryl mentioned earlier, there's going to be a lot of covenants and reports that you may need to submit to the bank. So you want to make sure that you have a calendar of all of those so that you're not missing any. Usually they require potentially interim financial statements at the end of a quarter, and all of them I've seen require audited financial statements at the end of the year, at least for the charter schools that I've worked with have all required that. And then there may be other certificates of things, insurance documents that you're required to submit on some regular basis. So, again, as you read through these documents, make sure that you set up a calendar of due dates. And then I think it's also very important to set up a covenant tracker. So the school that I'm on the board of, what we do is we have a tax exempt bond, and we have on our quarterly financial statements, we have where we stand at the end of each quarter for our covenants. And then we also have a projection of where we think we're going to land at the end of the year with those covenants. So the bank will have different covenants that they want you to make sure that you meet. So I think it's really important to kind of track that, on an ongoing basis. So the board, like I said, that we're on, or that I'm on, we know exactly where we stand, and if we're going to make the covenant or not make the covenant. It's a very important in my mind is if you're not going to make that covenant, to notify the bank as soon as possible, because they'd like to know if you're not going to meet it, and then you can kind of start working with the bank to either find a correction for that covenant or to get a waiver on the covenant. And sometimes covenants are written during the planning phase, as Sheryl mentioned. Make sure that you can make those covenants, but we've seen cases where at the end of all good intentions were made on the covenants, but then once they got into calculating the covenant, something came up, or there was a change in a standard, accounting standard that made the school fail the covenant. So they had to work with the banks. So it's easy to do that on the front end before you sign the agreements, but it could be done later, but make sure that you kind of are tracking those covenants. From an accounting side related to the construction, some pitfalls that we've seen here is well, maybe not a pitfall, but more of a suggestion. A lot of times when you're recording construction in a general ledger, you'll have a lot of different vendors, and people set up a general ledger account called the building or renovations and record everything in there. One of the things that I've seen that's been very helpful is organizations have recorded, set up general ledgers accounts that will have each major vendor in their balance sheet during the construction. So they might have the general contractor, they might have the architect, they might have some other sub vendors in there, and they record all the transactions by vendor into their own account. And what that does is during the course of the year, if they need to report back on any budget to actual or tracking or things like that, they're able to really identify the specific line items as it is in the budget. In opposed to going through a general ledger that may have 100 lines items and parsing out which is which. So the more detail you have, the better. At closing, when you complete the building and you put it in service, you can make a journal entry and combine it into one to call building. But that's just a kind of a trick that I've seen some organizations use that is helpful, during the construction phase and in reporting back phase. You always want to make sure you look at the value of the land versus the building, because you want to parse that out when you record that transaction, because land's not depreciated, the building will eventually be depreciated. When you're recording the general contractor invoices, you want to make sure you look at the date of that contract because, or the invoice, because the general contractor's invoices usually run behind a little bit. So the invoice that you get in July probably relates to June. So you want to make sure you record that at the end of your fiscal year to get a complete set of books, as well as the retainer. Usually on a general contractor's invoice, there is a retainer, a holdback of, 5 to 10%. You want to make sure that you're recording that as a liability because that's the completed and stored, but not yet paid or billed. So you want to make sure that you have recorded that to get the full cost of the building on the books at that point in time. So with that, I'm going to hand it back over to Sheryl, but that gives you some thoughts on the accounting considerations.
Eric, I think will handle the bulk of this, but I did want to reiterate that the transfer of bond finance property or even collateral property that's securing the bond financing but may not have been improved or acquired using tax-exempt bond financing. If you are planning to transfer that property, you're going to need to talk to bond counsel and determine what's going to be required. It is easier if the property only served as collateral, where the property was bond financed or improved using bond finance proceeds, then it may be more complicated to transfer that. I was recently on a transaction where the client was actually expecting to transfer 2 smaller pieces of property, and we actually excluded them from the collateral stack for the bond financing, just because it made everyone's life easier and gave them a little more flexibility with that property. I know that's not going to be an option for everybody, but it's worth kind of thinking about that and keeping that in mind. And I'll hand it back to Eric, who will talk about private business use and other post-closing requirements.
All right, so after the bond issuance is complete, there's some important rules to be followed in order to maintain the tax-exempt status of the bonds. These rules relate to spending and investment of bond proceeds, arbitrage rebate, record retention, and the use of facilities financed with bond financed property, financed with bond proceeds. Failure to comply with these rules may result in penalties, including the bonds being declared taxable. One of the things borrowers are required to do is to adopt post-issuance bond compliance procedures that describe many of these requirements. Mass development has a preferred form of procedures that is commonly used. We typically supplement those procedures for our clients with additional documents that describe the private business use rules in much greater detail. So the first set of rules are the arbitrage and rebate rules. These rules are quite complex. In general, if bond proceeds are used to acquire investments with a higher yield than the bond yield, arbitrage earnings are the excess return. Arbitrage earnings are subject to certain yield restriction rules, which limit the investment yield earned on bond proceeds, subject to certain exceptions. Unless an exception applies, you have to limit the yield on the investment of bond proceeds to a yield that's not materially higher than the yield on the bonds. The arbitrage rebate rules require that certain arbitrage earnings must be paid to the U.S. Treasury, which means that even if an exception applies to the yield rule, you might still have to pay the arbitrage earnings to the government. So an arbitrage rebate calculation must be done at least every 5 years, and the transaction documents typically provide information about consultants who can assist with that calculation. The next set of rules are record retention rules. The Internal Revenue Code generally requires retention of records for federal tax purposes. The bond record includes a number of documents that are generated before and at issuance of the bonds, as well as post-issuance documents such as records of investments, records of use of bond finance proceeds of property, and records of expenditures of bond proceeds. In order to ensure continued exclusion of interest for the bondholders, the borrower needs to retain the bond records. We recommend for the life of the bond plus 3 to 6 years. The IRS Form 990 includes a schedule known as the Schedule K, which requires disclosure of certain information in connection with tax-exempt bonds. Some of this information remains the same from year to year, like the bond issuer's EIN and the date of issuance. Other information changes and should be tracked from year to year, such as the amount of the bonds that have been retired, the amount of gross proceeds held in reserve funds. Schedule K also asks a series of questions about private business use, which brings us to my final topic, which is monitoring the use of bond financed property for private business use. With respect to a Section 501c3 borrower, private business use is the actual or beneficial use of tax-exempt bond finance property by any private person or for-profit entity, including an organization other than a Section 501c3 organization acting solely in furtherance of its own purposes and the borrower's exempt purposes, or a state or local government. Bonds won't qualify as tax exempt if private business use accounts for more than 5% of the net proceeds of the issuance in the case of a 501c3 organization. Governmental borrowers are subject to slightly different rules. Notably, all Section 501c3 use is also considered private business use for a governmental bond, but private business use can account for up to 10% of the proceeds of the bonds before they lose their tax exempt status. Like now we're going to launch another poll question. All right, so about a third of the respondents said that they have contracts for cafeteria services, and a little under half said that they lease space to other organizations or use short-term use of their facilities. These tie into what private business use is and what sort of contracts can give rise to private business use. In short, leases and occupancy agreements are obvious examples of private business use. Other agreements that can result in private business use include management and service contracts, contracts for after-school programs or private tutoring, incentive payment contracts, contracts for naming rights, rights to locate cell towers or solar panels, and food services contracts, which we asked about, like a contract to operate a cafeteria, are one of the really typical types that we frequently see involved with schools. All of these can potentially result in private business use. Outside use of property by a third party can result in private business use, even if it's just a one-time event. The IRS has established a safe harbor for management and service contracts that meet certain requirements. We recommend consulting with counsel before entering into these types of agreements to ensure that all requirements of the financing documents are met with respect to such use, and to ensure that the agreements meet the IRS safe harbor or will not result in use that, along with any other private business uses, would exceed the relevant 5 or 10% threshold. Specific exceptions also exist for contracts of no longer than 50 days, 100 days, or 200 days. Each of those categories is subject to different requirements. And there's also an exception for contracts that are purely incidental to the primary function of the property, such as janitorial services. Contracts for goods generally don't result in private business use, although contracts with a service component, like a printer lease, can. In addition to the tax requirements, bondholders, lenders, and mass development also typically require borrowers to obtain their approval for third-party uses of tax-exempt bond-financed property in order to protect their own interests in the tax-exempt status of the bonds. So a borrower can obtain specific approval for an event. That's really cumbersome, however, if you frequently allow outside use by other parties. So we often work with our clients and all those other parties to obtain approval of a building use policy that allows uses tailored to meet the private business use exceptions. If an organization is regularly going to allow outside use by third parties, having an approved building use policy of that type is a much more efficient method for allowing those sorts of outside uses. And I think that covers private business use.
Thank you, Eric. So hopefully we haven't made tax exempt bond financing sound too intimidating. Many of you have already used it successfully to build your school building. Especially now, the low interest rate makes this a very appealing option for schools, and may allow you to complete the project that you want, even in the face of increasing costs and climbing interest rates. Thank you so much.
All right. So we're going to take a look at some of the questions we have here, and people should feel free to insert any questions they might have in the Q&A function, and we'll go through these in order. All right. So the first question was posted at the outset of the presentation. I'm going to read through it and then perhaps and address it. So I work in a nonprofit charter school. I am suddenly receiving negative feedback from a couple of teachers who complain about a known policy where we do not refund for taxes. How best can I redraft the policy to explain why? So it sounds like there is a real legal issue here, possibly a combination of tax issues, and also HR or employment law issues. And I do think that it makes sense to consult with an attorney, but it's really outside of the scope of our presentation today. And also, this really requires a one-on-one consultation so that the attorney can understand the facts a little bit better. So, with regrets, I'm going to move on to the next question. All right, next question. All right. This is a long one. The chair and treasurer of the board of trustees of the charter school serve as the chair and treasurer of the board of directors of the charter school's Friends organization. Does that mean that the Friends organization needs to use public procurement each time they do renovations? So this is a complex question, but one that comes up a lot. You can understand why a charter school would want to have its chair and treasurer serve as chair and treasurer of its mission affiliate. But depending on the level of control over the mission affiliate, that might make the mission affiliate a governmental organization, which would, yes, require public procurement. So we'd have to know a little bit more about the level of control. But more importantly, one would have to look at some of the state ethics issues that might arise if the officers of the school are serving on the board of the Friends organization. Because if the two are contracting with each other, there might be some state ethics concerns with that arrangement unless the Friends organization is governmental. So this too is a fairly complex question that would need to be unpacked. All right, Eric, I think the next question I'm gonna pose to you, since you spoke about private business use. How is use of space calculated when determining whether private business use exceeds the 5% or 10% thresholds?
So there are different calculations that might be used. Ultimately, which one is appropriate is a determination that bond counsel makes. The most common calculation that's used, however, compares both the amount of space used by a third party to the total floor area of the building and the amount of time during which that space is used relative to the amount of time that the entire building is in use.
Okay. And isn't it also going to require an analysis of the equity versus the tax exempt bond proceeds, right? Because
it can.
Yeah. Okay.
Yeah, so there are other factors that play in. If a building has been financed in part with in part is not financed, but the organization has put equity into it, then that alters the calculation, because some percentage of the building can be set aside and used for private business use without implementing either the 5 or 10% threshold.
Right, right. And I would say, I find it more typical that a portion of the building is uses equity, but I have been in situations where the building was in fact 100% financed, and that created more problems, obviously. Okay, so moving on. Okay, this question: we used tax-exempt bond financing to acquire and renovate our school building, and so lots of private business use questions. Let's start with this one. When we first constructed the kitchen, we employed kitchen staff to purchase supplies and cook and serve meals. However, we think it might be more efficient to outsource the function to a company with expertise in school meals. What do we need to know? So this ties to the poll question about cafeteria services. So I will say that my experience with charter schools is that those that serve food have done so in a number of different ways. Some schools have had boxed lunches delivered. So there, the boxed lunches are prepared off-site and they're brought to the school, and that is not the kind of cafeteria services that might be considered private business use. Some schools have told me that they have their on-site kitchen facilities and they do employ kitchen staff, and they've told me that that is a way that they ensure that their students are getting really healthy meals, because they really oversee the food very closely, and that should be fine as well. That's not the kind of cafeteria service which might be private business use. But perhaps in the general world, the more typical situation is if an institution has a cafeteria, it will outsource the cafeteria services to a large cafeteria service provider like Sodexo, or there's bunches of these. I have been told that that if you have a tax-exempt bond financed facility and you are negotiating with one of these large food service providers, you should let them know upfront that your property is tax-exempt bond financed, because they do just have different contracts for tax-exempt bond financed facilities versus not. I don't know if that's true, but it's certainly worth a shot. Regardless, when you see the contract, you're going to have to take a look at it. The goal is to avoid having payment based on net profits. So that's one thing you're going to avoid during negotiation. And you're going to try to make sure it's not a very long-term contract that exceeds the useful life of the bond financed property. That's probably not going to be the case. Usually they're shorter term. And you're going to want to make sure that you have certain types of approval rights. Those are some key features in negotiating the terms. But the bottom line is you're going to have this reviewed by an attorney who has familiarity with the private business use requirements. And ultimately, that kind of contract might need to be reviewed by bond counsel if there are any questions. Because cafeteria service providers are considered to use the bond financed property to earn their living, and that is a potential private business use. All right, another question that comes up: a cell phone company has approached us about putting a cell phone tower on the roof of the school building in exchange for a fee. Is that permitted? So I don't want to be the one to answer all the questions. Does anyone else want to take this?
I would just say it might be permitted. It could be a private business use. So you would need to look at the terms of the contract, see if it could fit into any of the private business use exceptions. If not, then you need to take a look at it and make sure that it's below the relevant 5 or 10% threshold for private business use.
Right. So
Yeah.
I might answer that one a little different because I think it's a lease.
Mm.
And a cell phone tower is going to be a longer term lease. So it's if the bond finance, if the roof is bond financed, then I think it's always going to be a potential issue. And then, yes, you have to go deal with the threshold. And I would definitely consult with bond counsel, who often tracks the thresholds. But the reason why this is a good question is because we have a client that when it undertook its tax exempt bond financing, it made sure that no tax exempt bond financing was used for the roof. So the roof is very specifically carved out of its bond financed project. And I think it's because they knew they were going to have a cell phone tower at the top. I can't think of any other reason. I don't actually remember anymore, but it is carved out. And that's been really helpful. So it hasn't had to deal with this issue. And, you know, if you think about it, in most cases, you don't really, well, some cases you do renovate the roof. This is a city building with a flat roof. Yeah, so that worked for them.
I believe that when they acquired the building, the cell phone tower was already there. And so they knew they were dealing with it at the acquisition. I would say, you know, the other piece, although it's a little outside of our parameters, is the you know, is kind of the facility and admin piece of having someone with equipment on your roof who's going to need to access it.
Right. Not necessarily a good idea.
Right. My experience is that that's kind of a nuisance to the administration, who feels like it's outside of the scope of what they're here to do.
Right. And I will say similarly, billboard leases raise similar problems, although I think actually that may also raise some zoning issues on top of everything else, which I don't know about the cell phone tower. All right. Let's just see. Okay. And last question. We are considering allowing, this is also with tax exempt bond financing, by tax exempt bond financed property, we're considering allowing other schools and community groups to use our gym space when not required for our own use. Is this permitted? So to unpack this a little bit, you might find it a little easier to permit this use if the bonds are 501c3 bonds than if they're governmental bonds. And that's because with governmental bonds, any use by a 501c3 even would be private business use or potential private business use. Whereas when you're dealing with 501c3 bonds, if the use is consistent with the tax exempt mission of the borrower and the tax exempt mission of the user, it may be okay. You know, it's a question to explore. Otherwise, we are dealing with a lease situation. There are different types of lease arrangements. And what I'll say in very general terms is that the shorter the term of the lease, and the less negotiated the rate, you know, using a rate schedule, the more likely it's going to be that this is an exception. But one has to look at the terms of the agreement or the proposed agreement. And again, consulting with bond counsel is likely to be necessary. All right. Anyone have any other questions before we head out? All right, I think that will wrap up for the day, and thank you all for your participation, and feel free to get in touch with any of us with any questions. Take good care and have a great afternoon.
Bye, everybody.